Here is how the housing correction could impact you.
This difficult correction should put the housing market back into better balance.
With interest rates rising to nearly 7% and wages not growing nearly as fast as homes are appreciating, we're starting to see the market stagnate. Why? Because of affordability. It's nearly 37% more expensive to own a home today than it was just a year ago because of rising rates, because of home prices not moving down as quickly as some might have hoped. So it's putting strain on affordability. And because of that strain on affordability, we're seeing decline in buyer demand. And because of that decline in buyer demand, we're seeing homes sit on the market longer. We're seeing sellers start to drop housing prices, and we're about to head into the slowest time of year. So how will this correction in housing impact you? Well, let's take some time here and talk about it. Now, as most of you guys know, I am super bullish on housing, but today I'm going to take off that bullish cap and put a bearish cap on my head to talk about the likelihood of a correction happening, what that means for you, how it can impact you, which markets are likely to be impacted the most, as well as talk about some stories of houses on the market in my market at the moment to give you an idea of what's going on. Over the last couple of weeks, I've had people comment on my videos, show up to my lives, and say that the Fed has come out and said that they need housing to correct by 20%. Well, the Fed has never come out and said anything like that. They've basically just said what they're doing is likely to impact housing and that housing more or less needs a correction. They've never given a number on that correction. But with that said, the Fed could crash the housing market if they truly wanted to. All they have to do is continue to hike the Fed funds rate. In fact, they could have already crashed the housing market if they had just gotten even more aggressive than what they've already done. But the goal here isn't to crash housing. The goal here is to get inflation down because inflation continues to run out of control. And because of that, the Fed has gotten even more aggressive than many thought with regards to Fed funds hikes, and that has essentially impacted interest rates. While they're not directly correlated, the volatility in the market has impacted rates, and that's caused the housing market to stall. And that's why we're seeing the average homeowner out there at the moment lose about 2% of the value of their home since the peak in June. But what does that actually mean? So the average homeowner's lost nearly $8,800. Not really a big deal if you own $1 million home. Losing 2%, you've lost $20,000 on your home. So again, not a big deal. But for the people out there that purchased this year and put a minimal down payment down, losing 2% of the value when they only put 3% down, that can impact those people a little more than those that put a large amount down. And I think the fear in the market is that those people will likely be in distress at some point in the future if they lose their jobs and have to do a forced sale, which will lead to bigger price declines in the market, foreclosures, and prices crashing. While I don't think that's realistic that that's going to happen, you will see people impacted by job layoffs. You will see people impacted by price declines. Those people that have to sell for one reason or another. Now, in other videos, I've talked about the idea of people being locked into their homes because they financed a purchase or refinance with a super low interest rate. And so those people will likely stay in their properties. As interest rates are higher and home prices are higher, those people aren't likely to move unless they're forced to do so. In which case, that could lead to even further declines in the market. If those people have to sell, then they could end up selling for less than the most recent neighbor purchased their homes at. And in theory, that could start a trend. So what actually has to be true for that to happen? Or another way of asking the same question is, what could cause house prices to continue to correct? Well, many people out there believe that it's investors selling properties that they have because now they can get a better return owning bonds than they can owning some sort of investment property, with a 4.5% return. Now, I don't think that's likely because if an investor sells their property, they're going to have to pay capital gains on the sale of that property, which in turn would hurt their real return. So why would they go sell, investment property and buy a bond, for a very little return at the end of the day? Another thing that could happen is if interest rates continue to move up. If they continue to go higher, you're likely to see a bigger impact on housing prices. As we saw interest rates move towards 7%, We saw buyer demand continue to fall off. We actually saw less inventory coming on the market too, and those homes that are sitting on the market starting to do bigger price declines because there's less buyers out there in the market. And in order to entice these buyers, you've got to get those prices down, get that affordability down in order to sell those properties. But the other side of that is that if you believe that inflation comes down, or that you believe a recession is likely, or that we're in a recession, both of those things are deflationary, which should lead to lower interest rates. And if we head into a recession, that means growth stalls in likely all sectors out there, which means the Fed is likely to do some sort of quantitative easing, backing off rates, maybe even trying to stimulate the market by buying bonds again. You never know what the future holds. And another item that can continue to drive house prices down is new construction. While we don't have a lot of new construction here in Southern California, real estate is local, and we talk about that all the time. So if you're in a market that has a lot of new construction, that's just sitting on the market, it's not moving. The difference in a builder versus a seller is a seller can sit and wait for the market to improve if they want to sell, if they don't have to sell a property. Whereas a builder, they need to get rid of that inventory. They need that cash coming in many ways. So they need to sell those properties. So they're likely to reduce prices. They're likely to offer incentives. They're likely to do things that typical sellers aren't going to do in order to unload property, which, if you're in a market that has a lot of new construction, could cause house prices to go down even further. On top of that, you have the markets that appreciated like crazy last year, the Boise markets, the Phoenix, Arizona markets, those markets that went gangbusters. Everybody was wondering, how do you get a home here? Prices are selling way over the asking price. People are doing absolutely crazy things. I can't believe this. Well, those markets are likely to be impacted a little bit more than the markets that weren't quite as crazy. Now, I realize across the US, a lot of markets were crazy, but those that saw the most appreciation are likely to see a bigger pullback in this environment just because of how rapid it went up. You're likely to see home prices pull back a little bit further than other markets as things cool down. And another thing that could cause house prices to continue to correct is a huge amount of job layoffs and people needing to sell their properties, those forced sales that we talked about earlier, where people are selling for less than the most recent sale in the neighborhood, essentially driving down house prices. While I don't think any of these things are likely, they're all possibilities out there in the market. You never know when a black swan event is going to happen, like the pandemic, like COVID, if you will. You never know when something's going to happen that causes the next leg down. But I believe the fundamentals of the housing market are pretty strong. But again, all of these things are a possibility. While a lot of headlines out there are reading that the housing market is crashing and home prices are down 20 or 30%, there's a lot of markets out there that are actually down less than 1%. Now, on top of that, there are some markets that are impacted a little bit more at the moment. Markets like San Jose, Seattle, San Francisco, where they're saying home prices are down roughly 10%. Now, I don't know if that's accurate or not, because you never know how homes were priced based on fair market value. And I'm going to take a minute here and give you a couple of stories. Here in my local market, in fact, my neighbor has their house listed for $1.2 million. Now, this is a 2-bedroom, 2-bath property, just over 1,200 square feet. When it came on the market, I saw the price and said, this thing's at least $100,000 overpriced based on what it is, based on the condition of it. Either the seller thought it was worth way more than it actually is, or the agent told him it was worth more than it actually is. But either way, it's overpriced by at least $100,000 in my opinion. So at some point, that house is going to sell. Now, if it sells for what I think it's worth, it's probably going to sell for 1.1, which is going to show that it sold for around $100,000 less than the asking price, which is almost 10%. So when that property closes, you could look at it and say, well, prices went down by 10% because that home sold or reduced their price by X amount to get it sold. Well, it was overpriced to start. Now, I'm not saying that's what's happening in those markets, but I'm trying to provide a little bit of context for you. Another example is I sold a property earlier this year. It actually closed about 2 months ago here in Huntington Beach, California, and we started the listing at roughly 1.6 million. And the reason we did that is because there was a listing in the neighborhood that had sold for roughly $1,550,000. And so the sellers thought their home was nicer, thought it was in better condition, better location, and so they wanted to go above that asking price. Now, I recommended a number about where that one sold, but they thought it was worth more because of the things that I mentioned. And this is at the time where interest rates had already increased. So the other one closed closed in about March, which means that it went in escrow in January or February when interest rates were much lower. Well, we didn't list their property until about May. And in May, interest rates had creeped up quite a bit. Affordability was already coming into play. And so I knew that was going to be an issue in selling that property. But what happened is we ended up reducing that property from roughly $1.6 million down to $1.475 over about a 2.5-3 month period, at which point we received multiple offers and ended up selling the property for 1.5. Now you could look at that property and say, well, it sold for less than the last one that sold, therefore the market has declined in price. Well, I would say that property that sold at $1.550 should have never sold at $1.550. It was just the craziness in the market. It was the only one listed. That buyer wanted to buy that property and paid an absurd price for it. And yeah, that's a new comp, but at the same time, in my opinion, it should have never sold for that. So yeah, I might be justifying a little bit, but what I'm trying to tell you is that when you see price declines, make sure you're getting a little bit of context in it, because it's going to be a little bit different depending on where you are. We talk about real estate being local all the time. I'm in Southern California, near the coast. We have very little inventory on the market at the moment. We don't have a lot of new construction in my market. Therefore, it's all resales. And at the moment, sellers are staying in their properties because they have these super low rates. And that's going to create other issues, because without new homes coming to the market, you're likely to see homes just sit, especially if interest rates continue to stay, in that 6.5-7% range. So in all reality, I think you see home prices continue to move sideways, down in many markets, not down by 20%, but down a couple of percent here and there because of affordability, because of costs rising, because of inflation, because of seasonality, everything in the market. It's going to be a slower market, which means home sales are going to be down. And I also expect inventory to stay low, interest rates probably to stay somewhere where they are at the moment for the foreseeable future, which means buyer demand is going to be limited, which means if sellers want to sell their homes, they're likely going to have to reduce the price or get more aggressive in offering credits and things that we've talked about in other videos. But with that said, home prices aren't likely to crash. In fact, CoreLogic just came out with their year-over-year forecast, expecting home prices to appreciate around 3.5%. So if you're considering buying a house in this market, do me a favor and check out this video here.